morning, everyone. Thank you so much for taking the time to join us this morning for our market outlook. It's a pleasure to see everyone, and thank you for braving the rain. Of course, it was beautiful yesterday, and then we get this weather today. We have a nice presentation this morning, and afterwards I'm hoping that we can have a nice Q&A. I'm pleased to welcome Adrian Helfert, who is going to be our speaker. But before we start, I do want to introduce the Westwood staff that's here so that everybody gets a chance to see everyone. So we do have our advisors as well as our client service team. So if you are with Westwood, if you'll raise your hand so everyone can kind of see who you are. Thank you. We also have a few other individuals. We have Brian Casey, who is our CEO here. Dick Frank, who's the chair of our board. And we also have Matt Lockridge here, who is the Chief Investment Officer of our Domestic Value team. Matt and his team manages about $8 billion in assets for the firm, and Matt is back here. We're all available afterwards if anybody wants to grab any of us for a conversation. My name is Leah Bennett. I know most of you all. I'm the president of Westwood Wealth Management. I also have an investment team. We manage about $1 billion in assets for the firm, which are mainly tax managed strategies as well as some thematic strategies. And proud to have Adrian Helfert here. Adrian is the Chief Investment Officer of our Multi-Asset that manages about $8 billion in assets for the firm. Adrian has a fantastic background. He received his undergrad with an emphasis on physics and mathematics. Received his MBA from Duke, and then went to work on Wall Street in New York for a number of years before moving to London and working for a firm running some multi-asset strategies. And then we were lucky to lure him over to Westwood about 4 years ago. So please help me in joining Adrian, welcoming Adrian.
Great, thank you guys. Very nice to see you on a certainly rainy day. Don't let me stop you from your breakfast would be key. I know it's early. What I hope to give you today would be just a market outlook, and not just a market outlook, but maybe a framework. And I can tell you, if you've heard me speak before, you probably know that I try and stick to a really consistent framework of thinking about the world, thinking about cycles, thinking about how to analyze where we are in the world at large, what the economy might look like going forward. And then there's that second level thinking of, well, what does that mean for the markets? Us as investors are thinking about the allocation. How much should we have to equities? How much should we have to bonds? How much should we chase returns versus avoiding risks that are in the environment at large? And then my colleagues that are here, Matt Lockridge, Frank Tabor, are very in the weeds on understanding individual opportunities. So I hope you get a chance to talk to them about some of the things that we'll talk about as well. Those are selections. But just for a broad market outlook, I won't bore you with this. 2022, I have one slide on. It was a painful year. We had Russia that invaded Ukraine. We had inflation that started out elevated in 2021. It really got heated in 2022. We had the Federal Reserve that was hiking interest rates. We had China that started reopening at the end of the year. All of these things basically led to, we had 18 Federal Reserve Fed fund hikes in 2022. A Fed fund hike is 25 basis points. They hike multiple times at each meeting. It almost feels like that's normal now, but that's not normal. We had a really elevated environment, and the S&P was down nearly 20%. In a nutshell, that's what happened last year. So let's go forget about that and see what's going to happen in 2022. One of my consistent frameworks is I think about the world at large, and I try and break it down into distinct categories of what drives the market. Real rates. Real rates are that actual rate of return if you put cash in the bank and it gives you a 1% return and inflation comes in at 2% over the next 2 years. Suddenly you've actually deteriorated your buying power. That's no good. That's a negative real rate of return. That's where we came from. Real rates positive is an actual rate of return that you put your money in the bank and it increases your buying power. You might have made more money in equities, but at least you could buy a little bit more widgets just by holding cash. That's where we are now. We look at economic growth, not just economic growth and a forecast, but what the uncertainty of that growth is, what the outcomes look like. That increases the risk premium. We look at inflation. I would have said the same thing 5 years ago when it was a non-issue. Now it's an issue and it's on everyone's minds. And I boil it down to why inflation is a big deal. It's because of spending power impacts. It's because of what it does to the ability for you to go buy goods and services. And if you are a marginal consumer, if you are calculating your budget every month, it's important. And that's why the Fed is thinking about that. Credit is the financing cost for overall economy. It is financing growth is the way I think about it. Let's look where we are. As I said, real interest rates, if I boil it down, this is the expected risk-free rate of return. You put your money in the bank and you hold it in cash, and in 2 years' time, you want it to increase your purchasing power. You may not have made as much as you could have made in the equity market, or maybe you made more if the equity market was down like last year. But we went from, at the beginning of last year, a -2%, a degradation of your purchasing power when you put it in the bank. And what does that do? That forces you out into risky activity. That forces you out into putting your money into speculative activity, into where it is today. It's around 2%. At 2%, suddenly you go, well, am I going to put my money in 4% cash bonds that maybe give me a 2% real rate of return, or am I going to take the risk of getting shellacked like we did last year? It's a balance that maybe pulls people back from risky activity. That's why it's important. It's important for the outcome of the economy. When real rates are higher, it becomes more attractive to hold your cash in the bank instead of financing risky activity. I said the Fed funds went up 18 times last year. When the Fed hikes rates, recession happens. Oh, let me go back here. It's just pretty clear that almost every time the Fed goes down a hiking path, we see a recession happen. They're effectively pulling the punch bowl. They're saying, we're going to restrict economic activity. They do it for multiple reasons. Maybe there's an overheated economy in the housing market. Maybe there is a heightened inflation expectation. Maybe there's a concern around financing bubbles and unwind of that they try and restrict from. Maybe they're being pro-cyclical in the way they act. Either way, if you look at the very end, you can see that we've hiked rates dramatically fast. And we're waiting to see what happens next. We're waiting to see the trail effect of, will that lead to a degraded economic activity? The indicators say that's a high possibility. The Treasury curve, if you haven't thought about this before, this is the 10-year U.S. Treasury yield less the 2-year U.S. Treasury yield. These are both risk-free rates. The 2-year U.S. Treasury yield, me as a whole fixed income guy, I follow these things all the time. 2-year U.S. Treasury yield is one that gives you an idea of what the Fed funds are doing. The 10-year U.S. Treasury yield is a proxy for real growth rates in the economy. Real growth rates go down, or the expectation of those rates go down, then you have an inverted curve. It drops below zero, that light fainted line there. It's a big forecast indicator of every time it goes below zero, we hit a recession. Similar to when the Fed hikes rates. Well, guess what? We are not only below zero, we're at some of the lowest rates since the 1980s in an inverted curve. The 10-year U.S. Treasury yield is less than the 2-year Treasury yield, telling us forecast growth is not looking up, it's looking down. As an indicator, it's giving us an idea of what might happen in the future. The Fed, what's the Fed telling us? The Fed watcher. The Fed minutes come out today, what they talked about in their meeting at the last meeting. What are they telling us? They're telling us that first line up there, get the pointer to work. The bigger mistake is to not attack inflation. The Fed itself is a dual mandate body. They focus on optimal inflation, or I should say 2% inflation and optimal labor markets. Right now, we're well above 2% inflation. We're around 4.4% PCE, what they call it, which is what the Fed follows. So we're well above, and they're focused on that. They're focused on, if you look at the last bit, at the bottom, The price stability is what they're focused on. The economy doesn't work for anyone. They're really focused on not necessarily the higher end consumer, the lower end consumer, the ones that are at a marginal budget, because when the price of milk goes up, it really impacts the economy. It hurts jobs, it hurts people in the long term. So that's what they're focused on. They're telling us that directly. As long as inflation remains elevated, then they're going to be focused there. A scary chart, I thought about pulling this one because it's a lot of data on a page, but just looking at it, I find this important okay, so I've said that the Fed is hiking interest rates, and I showed you that chart that said that they might be stopping hiking interest rates. The indicators tell us the San Francisco Fed proxy rate, the Taylor rule, these are just rule-based methodologies that tell you can read about it later at the bottom, what the Fed funds rate might be. It's telling us it might be double where we are now. The S&P 500 was down 20% last year, with us going up to 4.5%. Imagine if we were now at 9%. The indicators are telling us that's a possibility. I'll tell you why that's unlikely, highly unlikely, but it's noted. We are still in an uncertain economic environment. We're still waiting to see what happens with inflation and economic growth. The last bit of when I talk to you about a consistent way to think about the economy, a cycle, I think about a vicious and a virtuous cycle. A consistent would be, okay, well, I feel good, I can walk across the street, that's consumer confidence. I can get a new job, I can see my bonus come in, I know I'm not going to lose my job, so I go out and I consumer spend. I buy the trampoline for the backyard, I buy the toys for my kids, the fancy red car, in which case companies start buying more things to manufacture widgets, and as they do, then they hire people to man those machines, and people that hire to manage the people that man the machines. That's more demand for jobs with the same supply, thus wages rise. That's what we've seen. Jobs are very plentiful right now. Unemployment is very low, wages are going up, and so consumer confidence should be okay. We start to look for ticks in this. Where's the problem? Well, I'll just tell you, as opposed to forcing you from your breakfast to look at all the charts, consumer sentiment really took a hit. It went to the doldrums after COVID. It's ticked back up a little bit, but make no mistake, the forward consumer sentiment, the concern is there, but it is starting to improve. Consumer spending has done pretty okay, actually. We're starting to see services spending come back over just straight goods spending. We're starting to see discretionary over non-discretionary. So you're not just replacing your washing machine, you're buying that trampoline for the backyard, things you don't have to buy. It's done okay. We're back to pre-pandemic levels on spending. Unemployment rate, I say it's a tailwind and potentially a problem. It's a tailwind because the unemployment rate is about the lowest in the last 50 years. If you want a job, you can find a job. They're there. It's a problem because that means demand is very high for unemployment while supply remains the same. Wages rise. When wages rise, inflation goes up. The Fed finds that to be a concern. They hit the brakes a little further. They pull the punch bowl back from the party and throw it out in the yard. Unemployment is both a tailwind and a problem. We actually need unemployment to rise a little bit for the economy to do well. Capital expenditures are about stable. I'll talk about wage inflation. Wages rising faster than core inflation. That is good for your purchasing power. Your wages go up by 7%, or PCE goes up by 4.5%. You could buy 2 bottles of milk, not just one. That's good for the purchasing power, but that also means that goods inflation is going to rise. It means that companies are going to have to pay people more, and to keep their margins stable, they're going to have to rise the price of goods as well. This is what the Fed's trying to battle. We would actually like to see wage growth come down. I feel like I have to talk about housing markets because we just saw the dramatic rise in the mortgage rate. That is probably going up a little further. Higher mortgage rates make housing less affordable. Not only that, but we saw this dramatic rise in house prices. So on the lower right-hand side, you see where the affordability index has gone down substantially. We actually have seen house prices come up a little bit already. We anticipate they'll come down a little further, but we're not looking for an unwind of housing prices. We've got expertise in the audience with my old realtor that's here. Please feel free to engage him, but it's one of those things where we've got a supply that is very low right now. When you Zillow around your neighborhood, like I often do, and look what's for sale and what the prices are, because it might impact the house price of my own house, there's nothing for sale, there's nothing out there. maybe we see that migration effect kick up again. But right now, there are buffers from us having a dramatic house price drawdown. One of those is supply. One of those is that we just went through a big house price downturn, and that means that we have better lending standards. People are not defaulting on their homes like they did before. I'll just go through this quickly. I talked about there's a couple of indicators that give us an idea of where we are. The leading indicators, you can read up the eye chart at the end later at your leisure. But fundamental indicators of the economy are telling us that in the forward trajectory, we are going to see lower growth. And I put the recession word on here a lot. We can talk about it further. It's a word. It's a word that's a zero bound on growth. But really we should just be talking about, we're looking at a lower growth paradigm. We're looking at where economic growth for 2023, the consensus itself is around 0.5% real growth, where the average long term is around 2%. So whether I say recession or not, we're looking for a consensus that is lower growth. And we'll talk about whether that's priced in. Inflation itself, have to talk about the actual level of inflation. We've got headline inflation, you'll hear on CNBC, Bloomberg, that's around 6.5% right now. That's pretty elevated. That includes food and energy. So inflation X food and energy would be called core inflation. That's one measure the Fed and others look at. That's running around 5.5%. Then if we extract housing prices and just look at kind of services inflation, that's around 4.5%. Core PCE, personal consumption expenditures, it's around 4.4%. The Fed's mandate is 2%. So if I'd drawn a nice little line there at 2%, what the Fed is saying is we have to get back to 2%. We're a long way from that. That's the bigger story. They could continue putting their foot on the brake by getting us back to 2%. The supply chain is one of the big problems there. If you're a leader in industry, if you've had a company and you're managing your supply of widgets for your customers, you know this. It's been hard to get supply, partially because of COVID, partially because of geopolitical risk in the environment. So the Russia-Ukraine was an issue. Now we see much more easing. We can see it in the LA port system. We don't have all the ships in the LA port system blockading from getting goods to end manufacturers. That is good when you predict it out. I put my little dots at the end there. You can see it's got a meaningful effect on lowering inflation. That's very positive. So looking forward, there are a lot of positive indicators. I don't want to be a howling, screaming recessionary forecast up here. There's a lot of positive indicators, and this is what our Federal Reserve is looking at as well. And inflation expectations, they'd be justified in saying at this point that, well, we've already broken the back of it because inflation expectations are low. Inflation expectations being, what do you expect inflation to be in the future? Right now, if you look 10 years out in the future, we're down at 2.2%. That's pretty close to the 2% barrier. Even just looking a year out, 2 years out, the inflation expectations priced by the market is only around 2.5%. That's a positive. They can say, you know what? This is near-term transitory inflation. We have broken the back of inflation. Let's take our foot off the brake a little bit so we don't kill the economy, so we don't have too many layoffs, so we don't actually hurt people's jobs prospects while they're getting into near-term inflation. I'll talk about credit. On slide, credit is important because credit is the financing mechanism for company growth. Credit is the ability for us to earn a default compensation for companies that we lend to. One of the most important indicators that I look at, another one you'll see on CNBC and Bloomberg all the time, Senior Loan Officers Survey, where they go out and they pick up the phone and they call senior loan officers around the country and say, are you tightening lending standards? Are you making it more onerous on borrowers? Yes, they are. How's loan demand? Loan demand's kind of going down. What are banks doing? Are banks concerned about their books, their lending books, their credit card books? Yeah, they are. Banks are adding to their reserves, their loan loss reserves. They're a little concerned. No surprise. That's kind of where we are in the economy. If you look at 2008, you see tightening standards went up dramatically. If you look at back in 2000, same thing. Loan demand went down, tightening standards went up. That's where we are today. Doesn't mean we're going to hit a stop in the economy, it doesn't mean we're going to hit a recession. It does mean that credit is likely to become a little bit more expensive for borrowers. It is likely to be a little bit more constrained. The fundamental landscape, so we talked a lot about the macro. Let's just do quickly on the fundamental and where we are. We are going through an earnings recession right now. The average earnings of companies for Q4 is just coming in. We're in negative growth for earnings, and you can see that where the arrow is there. The consensus I've got there going forward is you see another 2 quarters of consensus negative earnings growth. That's an earnings recession. That's the worst earnings season we've seen in 20+ years. So this doesn't mean it's not priced. The S&P was down 20+% last year, so to say I'm not being a typhoid Mary up here, but it does mean that we're going through what is priced last year, in part at least, of earnings are coming down. Maybe some companies are tanking a little bit and throwing in some of the stuff that they would otherwise do because they have the opportunity to do so by the markets. Let's look at the fundamental commentary. As I said, we've got some experts in the audience that are consistently talking to CFOs, reading through this, finding opportunities, because it's not just what happened in the past, it is those catalysts, those opportunities that happen in the future that we dig around to find. Bank of America is telling us that, they're saying consumer spending that's consistent with a reasonable growth environment. That's not so bad. Pepsi on the lower right-hand side, I find that one interesting. They're starting to see, it's called price elasticity. They're seeing the price elasticity or the price impacts of when prices go up, volumes come down. That's a consistent theme that we're seeing now. Where do we hit that price elasticity point? So right now we're seeing prices go down. We're starting to see that point of volumes coming down. That is impacting companies. You saw Maersk, they're one of the largest global shipping companies in the world. This is what I was referencing earlier of things like the LA port system that is now loosening and will bring down inflation and is positive. Quickly go through the market landscape, where we are in pricing. I find it kind of surprising that, okay, so I just told the story of what happened last year. I just told the story of where macroeconomics are okay, there's some signals out there which are concerning. You might expect that I would then tell you, well, the S&P 500 valuation, we oftentimes look at a price to earnings ratio, how much you pay per unit of earnings. And right now it's actually a little bit rich. A little bit rich means it's a little bit expensive. The value you put on each unit of earnings is a little bit more than average right now. If you look at that tail point, the green line is out till the end of the year, and I put a little dot, that's about where we are now. We're above the long-term, the 25-year average on valuations. Things are still a little bit rich. Now, as an investor, I can tell you that doesn't mean they don't get richer, they don't get more expensive, they don't go up in price, that when interest rates come down, then opportunities push multiples higher. But this is where we are now. We're not at super cheap levels. This is an environment where selection is super key, of finding those good opportunities that I just pointed at of individual companies is key, and more so than just saying, I'm going to broadly put my money in because everything is so cheap right now, I'm going to put the chips on the table. That's not where we are. I like to look a little bit at what happened last year. It's just this, I find this to be one of the bigger stories of last year. If you just forget all the other stuff and look at that right-hand side chart, earnings growth went up last year. The S&P 500 price return was down 19.4%. That means everything last year was really, it was multiples. The expectations came down of how much you're going to pay per unit of earnings. So this year, I would say, is a year of, well, is that realized? We're seeing it kind of realized now. This is kind of the bull case. When we see earnings come in a little bit better than expected, we're expecting earnings to come in down. This is basically what this is telling us. We're expecting earnings to experience a little bit of a recession, and we saw that last year. So this is saying, how much of that last year priced in what we're actually seeing in now? A lot. We're saying, even though we had positive earnings growth last year, markets were down 20%. This year we're seeing earnings down. Much of it was priced in already. There's some positivity to this. I talk about credit. This is an eye chart as well, but basically the cost of financing for companies, the credit cost of financing, how much you pay over risk-free rates for your default risk. When you lend to someone, you say, you know what, I'm going to lend to you at the cash rate, 4% plus. At Lockridge, if I think you are likely to default on my loan and not pay me back, then I might charge you another 10%. Let's make it 9. But that's the credit cost of financing. It's about average over the long term right now. That means companies are saying, okay, well, default risk is about average. It also speaks to we're at a lower systematic risk area. We're not looking for a super dramatic downturn. We're not looking for the world to blow up, as we saw in the global financial crisis in 2008. Investment yields, that said, companies were not just paying credit costs, they're paying an all-in yield. When you borrow, Lockridge is not just paying that extra 6% over the risk-free yield, he's paying 10% on that loan that I made to him. Well, high-yield borrowers, so your proverbial high-yield technology company, at the beginning of 2022, they were borrowing at 4.1%. And it was a high-growth environment. They're borrowing at 4.1%. In 2021, the S&P was up 20+%. Gosh, they're like borrow every day for all kinds of projects that are positive net present value projects. Today, we're talking about less prospective growth. Things are a little bit more uncertain. And you have to borrow at 9+% on your high yield bond. Those projects become less attractive. You kind of see another thing on the vicious cycle here of it's concerning when yields go up if we're not looking at a high growth environment because projects become less attractive. You're not going to deploy more capital to positive NPV projects because there are not many positive NPV projects. Just on the lower right hand side, just the left hand side, so you focus. I like to focus as well on the asymmetry of fixed income. So when we think about, we're just talking about allocation and macro here, talk about the environment we're in. Now you're thinking, do I put more money in fixed income? Do I hold more money in the equity market, the S&P 500? Well, the S&P 500 is generally a symmetric return profile. Things go up by 5%, they go down by 5%. Where fixed income is asymmetric, especially when yields are higher. That means that at the beginning of 2022, that 1.9x is when things go well, when the spread compresses and you pay less credit compensation and risk-free yields go down. My upside outweighs my downside by 1.9x. That's not bad. Guess what? Today it's 3.9x. So your upside outweighs your downside dramatically. It's a positive buffer that you see with investment yields. So when yields are at 9+%, you can see a substantial downtrend in economic activity or the markets for them, and you still earn the 9%. It's a buffer. Let's just pull that all together now and see kind of where we are. What I've said, real rates, that real rate of return, they are headed higher. As I said, that's a pulling the punch bowl effect. That's a design by the Federal Reserve for where they are looking to restrict a little bit of economic activity. It's called the portfolio balance channel, where it's less attractive to put your money in risky activity. It's restrictive policy. What the opportunities there? I think the opportunities are we see inflation turn. We see inflation come down some. Fixed income provides a buffer and should be held. Economic growth, we're experiencing a downtrend. I've got a call for a near-term recession. It's just an R word. We're at 0.5% expected consensus real growth for 2022, so it's not that much of a call to make, honestly. We're going to see lower growth in the future. So what do? It's a selection-oriented environment for sure. You leverage the expertise, like we have in the room here, to find good opportunities for companies that have resilient margins. When inflation goes up, when wages keep rising, and companies experience a compression of their ability to make profit on their revenues, let's find those opportunities. Let's find those opportunities where the revenue stream is mispriced. That's the opportunity now. It's not a beta opportunity where you just say, I'm all in because